Within the closed chambers of the Federal Reserve and the European Central Bank lie documents that will never reach the public domain. These are not scenarios for systemic crises or emergency liquidity plans. They are actuarial calculations of the pension liabilities of developed economies projected out to 2070. The figures there look as if someone entered the wrong formula in Excel. But the formula is correct. It's just that the math has stopped working in the system's favor. A pension is a promise of future money in a world where future workers are becoming fewer. This is not a social problem. It is the largest financial derivative in human history, built on one fundamental assumption, that tomorrow there will be more people than today. That assumption no longer holds. And when the market grasps the scale of the problem, the repricing will be painful. Most pension systems are already technically insolvent. The actuarial gap, the difference between promised payouts and real assets, measures in tens of trillions of dollars. But these liabilities are not reflected on national balance sheets. They exist in a parallel accounting system where default is postponed for decades until demographics turn a deferred problem into an inevitable one. Population aging is not a demographic trend. It is the main macroeconomic shock of the 21st century, the consequences of which are just beginning to manifest in the structure of capital, the strategies of investment funds, and asset pricing. To understand the nature of the looming crisis, one must abstract from social rhetoric and look at a pension for what it is from a financial standpoint: a deferred liability with a fixed execution date and a floating cost. A pension system is a contract between generations, formalized as a financial instrument. The working generation pays contributions, which are converted into promises of future payments for current retirees and for themselves. In this sense, a pension functions like a debt obligation. The state or a corporation undertakes to pay a certain sum in the future in exchange for contributions today. Historically, this model emerged under conditions of growing demographics. Bismarck introduced the first state pension system in Germany in 1889, setting the retirement age at 70, at a time when average life expectancy was around 40. A pension was conceived as an exception, not the rule. By the mid-20th century, the post-war baby boom created the illusion of sustainability. There were 6 to 7 workers for every retiree. The system worked not because it was well designed, but because demographics created excess cash flow. Most modern pension systems are built on the pay-as-you-go (PAYG) principle, a distributional model where current contributions immediately go to pay current retirees. This is not a funded system where individual contributions are invested and returned with a yield. It is a financial pyramid legitimized by the state, which only works under the condition of a constant influx of new participants. The key parameter of any PAYG system is the dependency ratio, the ratio of workers to retirees. In 1950, in developed economies, this ratio was roughly 7.1. By 2020, it had fallen to 3.1. By 2050, it is projected to be 1.5.1. The math is simple. If each worker must finance not 1/7 of a retiree, but half or a third, then either contributions triple or payouts are halved. But there is a second hidden problem. Pension liabilities are not reflected in official government debt. When a government issues bonds, that debt is accounted for on the country's balance sheet and affects credit ratings. Pension liabilities exist in a parallel reality. They are not considered debt until they are paid. The actuarial gap is the difference between the present value of all future liabilities and the system's current assets. For most developed countries, this gap is 200–400% of GDP. The International Monetary Fund, in its confidential stress tests, estimates the total off-balance sheet pension liabilities of OECD countries at $78 trillion. That's 3 times their official government debt. If these liabilities were accounted for under corporate reporting standards, most developed countries would be technically bankrupt. Why hasn't the system collapsed yet? Because pension liabilities are stretched over time. Default is postponed for decades. Politicians making decisions today are not held accountable for payments due in 30 years. This creates a structural incentive to ignore the problem. The second factor is government guarantees. Unlike corporate pension plans, which are regulated by strict funding rules, state systems have unlimited access to tax revenues. Theoretically, the state can always print money or raise taxes. But in practice, there is a limit to how much the tax burden on the working population can be increased before it begins to undermine economic growth. And printing money creates inflation, which destroys the real value of pensions. The third factor is the political toxicity of reforms. Retirees make up a significant part of the electorate in developed countries. Any attempt to cut promised payments meets powerful political resistance. The 2023 French protests against raising the retirement age from 62 to 64 are a harbinger of what awaits other countries. The illusion of pension system reliability has been maintained for half a century thanks to a unique demographic window. That window is closing. And when investors begin to factor the real cost of pension liabilities into sovereign risk assessment, the cost of borrowing for many countries will rise sharply. To understand the scale of hidden liabilities, one must understand the methodology for calculating them. The actuarial present value of pension liabilities is calculated by discounting all future payments to the present. Key parameters: life expectancy, replacement ratio, benefit indexation, discount rate, and wage growth dynamics. The problem is that even slight changes in these parameters create huge swings in liability estimates. If life expectancy increases by 2 years, a conservative forecast, liabilities grow by 5 to 7%. If the discount rate falls by 1 percentage point, the present value of liabilities increases by 15 to 20%. With today's low rates, this effect is amplified. Consider a concrete example. The state promises a pension equal to 50% of the average salary to a person retiring at 65 who is expected to live until 85. Average salary, $50,000, pension, $25,000 per year. Simple calculation, $25,000 multiplied by 20 years or $500,000. But that's nominal money. To calculate the present value, we need to discount. At a 3% annual rate, $25,000 in 20 years is worth about $13,700 today. The sum of all discounted payments is approximately $370,000. This is the state's liability to one retiree. Now add indexation for 2% annual inflation. The pension grows, and the present value increases to $420,000. If the person lives not 20 but 22 years, quite likely given current trends, that adds another $40,000. If the discount rate falls to 2%, the present value soars to $520,000. Multiply these figures by tens of millions of retirees, and you get an astronomical sum. In the U.S., about 65 million people receive Social Security. This program alone has unfunded liabilities, the gap between promised payments and current assets, of about $22 trillion in the 75-year projection. That's equivalent to 100% of GDP. But that's just the federal program. Add state and municipal pension liabilities, another $4-5 trillion corporate defined benefit plans, another $2-3 trillion federal employee pensions, $1 trillion. The total pension liabilities of the U.S. exceed $30 trillion, or 130% of GDP. And that's under conservative actuarial assumptions. Europe is in an even more difficult position. The European Commission estimates the total pension liabilities of EU countries at 250-300% of average GDP. For individual countries, the figures are frightening. Greece, about 450% of GDP. Italy, 350%. France, 300%. Even relatively prosperous Germany has liabilities of about 200% of GDP. These liabilities are not reflected in official government debt. They exist in a parallel reality where governments can make promises without acknowledging them as debt. But economic reality is inexorable. A liability is a liability, regardless of how it is accounted for on the balance sheet. Rating agencies are beginning to realize this. S&P, Moody's, and Fitch increasingly include pension liability analysis in their sovereign credit risk assessments. The state of Illinois received a rating on the brink of investment grade, largely due to huge unfunded pension liabilities. Puerto Rico defaulted in 2017, and pension liabilities were one of the key factors. When the market fully reprices this risk, the spread on government bonds of countries with large pension liabilities will widen. This will create a vicious circle. Higher borrowing costs, larger budget deficits, need to cut spending or raise taxes, slower economic growth, even higher borrowing costs. History shows that such crises are resolved through a combination of measures: tax increases, benefit cuts, raising the retirement age, and hidden expropriation via inflation. None of these measures are politically popular, so they are postponed until the last moment when there is no choice left. Demographics is the only macroeconomic trend with near absolute predictability. The people who will retire in 2040 are already born. Their numbers are known. The rate of aging is known. The only variable is migration, but even mass immigration cannot compensate for the structural shrinkage of the working-age population on the scale needed to stabilize the system. Three fundamental demographic shifts are transforming the world's financial architecture. First, declining fertility. The total fertility rate, TFR, in developed countries has fallen below the replacement level of 2.1 children per woman. In Japan, TFR is 1.3. In South Korea, 0.8, the lowest in the world. In Italy, Spain, Germany, about 1.3 to 1.5. Even the US, traditionally having higher fertility among developed countries, has dropped to 1.7. This means each new generation is 30 to 40% smaller than the previous one. In 25 years, the number of people of working age will shrink in absolute terms, despite increasing life expectancy. The second shift, increasing life expectancy. In 1950, average life expectancy in developed countries was 66 years. Today, 82 years. Forecasts point to 88 and 90 years by 2050. A person retiring at 65 today will, on average, live 17-20 years in retirement. For pension systems, this means not only more payouts but also exponential growth in healthcare spending in the final years of life. The third shift, shrinking of the working age base. Even if the retirement age is raised, the number of people in peak productive years, 35 to 55, is shrinking in absolute terms. In Japan, the working age population has already shrunk by 10% over the last 20 years. In China, this trend is only beginning, but its scale will be enormous. By 2050, China will lose about 200 million people of working age. The dependency ratio becomes a central financial indicator. In 1950, for every person over 65 in developed countries, there were 7.3 workers. Today, 2.8. By 2050, 1.4. In Japan, this figure is already 1.8. In 15 years, it will drop to 1.2. What does this mean in financial terms? If in 1950 each worker effectively paid 14% of their income to support 1/7 of a retiree, by 2050 it will require giving up 40 to 50% of income to finance half a retiree per worker. This is mathematically impossible without destroying incentives to work and economic growth. Median age. The median age of the population is the second critical parameter. In 1950, the median age in developed countries was 29. Today, 43. By 2050, 49. Japan has already reached 49. Italy and Germany, 47. This means half the population is older than 49. An economy with such an age profile functions differently. Less innovation, less risk-taking, less consumption, more savings, and fewer investments in growth. The geography of the crisis is uneven but predictable. Developed economies will be the first to enter a phase of acute strain. Japan is already at the forefront. Its pension spending is 10.2% of GDP, and that's just direct payments without healthcare. Italy, 15.4% of GDP. Greece, 16.9%. For comparison, in the US, 7.4%, but the American system has huge off-balance sheet liabilities in corporate pension plans and Social Security. Japan represents a laboratory of the future for all developed countries. Its population has been shrinking in absolute terms since 2008. By 2050, Japan will lose another 20 million people. Meanwhile, the number of people over 65 will grow to 38% of the population. 1 in 3 Japanese will be a retiree. The government has already raised the retirement age, cut benefit indexation, and actively encourages work after 65. But even these measures are insufficient. Japan's Government Pension Investment Fund, the world's largest pension fund with assets of $1.6 trillion, is forced to take on more risk, increasing its share of stocks and foreign assets. Europe will face peak spending between 2030 and 2040, when the baby boom generation retires en masse. Germany, France, Italy, Spain, in all these countries, demographic structure creates a synchronized shock for public finances. Germany has one of the most generous pension systems in Europe, but its sustainability is questionable. The replacement ratio in Germany is about 51%, meaning the average pension is half of the last salary. But to maintain this level, the contribution rate has already risen to 18.6% of salary, split between employee and employer. By 2030, it could reach 22 to 24%. Meanwhile, the number of working Germans is shrinking, from 50 million in 2020 to a projected 43 million by 2040. France demonstrates how politically toxic pension reforms are. President Macron's attempt to raise the retirement age from 62 to 64 sparked months of protests and nationwide strikes. And this is despite the fact that the French pension system is already running a deficit of about $14 billion per year. Without reforms, this deficit will double by 2030. France spends 13.8% of GDP on pensions, one of the highest rates in the OECD. This is not sustainable. Southern Europe, Italy, Spain, Greece, Portugal is in a particularly vulnerable position. High pension spending combines with low economic growth and high public debt. Italy spends 15.4% of GDP on pensions, with public debt at 145% of GDP. Its economy has barely grown in the last 20 years. Italy's median age is 47, the second highest in the world after Japan. By 2050, it will reach 52. How can an economy with such an age profile generate growth sufficient to finance pensions? Spain has experienced a particularly rapid demographic transition. Its TFR fell from 2.8 in 1975 to 1.2 today, one of the sharpest declines in history. Meanwhile, life expectancy has risen to 84 years, the highest in Europe. Spain's pension system went from surplus to deficit in the last decade and now requires ever larger transfers from the general budget. China presents a separate and particularly alarming case. The one-child policy created a demographic time bomb. China is aging faster than it is getting rich. By 2050, China will have over 400 million people over 65 with a shrinking workforce. China's pension system is extremely fragmented and underfunded. The replacement ratio, pension to last salary, is already falling. Chinese households are forced to save about 30% of their income to prepare for old age, suppressing domestic consumption and making the economy dependent on exports. The scale of the problem becomes obvious when looking at the numbers. In 1980, China had 76 million people over 60. Today, 280 million. By 2040, there will be 450 million. That's more than the entire population of the US. Meanwhile, China's workforce peaked in 2015 and is now shrinking by 3 to 5 million people per year. By 2050, China will lose about 200 million people of working age. China's pension system has 3 tiers, but only the basic state pension covers the majority of the population. The average pension in cities is about 3,000 yuan per month, approximates 420. In rural areas, less than 200 yuan, 28. And this is while living costs in Chinese cities are rising rapidly. The urban pension fund is already facing a deficit in some provinces, requiring transfers from the central government. Moreover, the Chinese system relies on the traditional model where children care for parents. But the one-child policy destroyed this model. A 4-2-1 structure has emerged: 4 grandparents, 2 parents, 1 child. The younger generation physically cannot bear this burden, and the state system is not ready to replace it. The United States is in a relatively better position thanks to higher fertility and immigration, but the problems are enormous. The Social Security Trust Fund, the main mechanism of state pension provision, is projected to exhaust its reserves by 2033-2035. After that, the system will only be able to pay about 80% of promised pensions from current contributions. Politically, this is toxic, either raising taxes on workers or cutting payments to retirees. But Social Security is only part of the picture. Corporate defined benefit pension plans in the U.S. have a total funding deficit of about $300 billion. Many large corporations have frozen their pension plans and transferred employees to 401k, defined contribution plans. This means millions of Americans bear the full investment risk of their retirement savings. The median balance in a 401k for people aged 55-64 is just $61,000. That's enough to generate about $2,500 in annual income with a conservative 4% withdrawal rate. Add Social Security, average payment about $1,800 per month, and the median American retiree lives on about $24,000 per year. That's a significant drop from a median household income of about $70,000 for workers. Emerging markets once hoped for a demographic dividend, a period when a large part of the population is of working age. But this dividend is shrinking rapidly. Brazil, Thailand, Vietnam are entering a phase of rapid aging without developed pension systems. They are aging under conditions where institutional infrastructure is not yet ready. Brazil is a telling case of premature aging. The country spends about 12% of GDP on pensions, more than many developed countries, at a middle-income level. Brazil's pension system is extremely generous for certain categories, public servants, military, creating huge privileges. Some categories can retire after 30 years of service regardless of age. Women can retire at 62, men at 65. With a life expectancy of 76, this means 14 years in retirement for the average person. The 2019 reform tried to tighten the rules but faced massive resistance. Even after the reform, Brazil's system remains one of the most expensive in the world relative to its level of economic development. By 2050, when the share of people over 65 grows from 9% to 22%, pension spending could reach 18–20% of GDP. This is financially unsustainable. Thailand demonstrates another problem: aging without an adequate pension system. Only 20% of Thai workers are covered by formal pension programs. The rest rely on savings, family support, or continue working into old age. Thailand's median age is already 40 and will reach 50 by 2040. This is an impoverishing society without social protection for the elderly. There is a temptation to think that technological progress or productivity growth will compensate for demographic shrinkage. The math says otherwise. To compensate for a drop in the dependency ratio from 3.1 to 1.5.1, labor productivity would need to double every 25 years. Historical productivity growth rates in developed countries are 1 to 2% per year, meaning doubling every 35 to 70 years. Even under optimistic AI and automation scenarios, productivity gains cannot compensate for the demographic collapse on the required scale. Moreover, high productivity does not necessarily translate into higher pensions. If robots and AI replace human labor, the base for pension contributions shrinks. Pension systems are built on taxing wages. If a significant part of economic activity is created by capital, not labor, where will contributions come from? Some economists propose a robot tax, but that creates its own problems and remains a theoretical construct for now. The demographic transition also creates regional imbalances. Migration from poor regions to rich ones can partially offset aging, but creates political tension. Europe has accepted millions of migrants in recent decades, helping demography but causing political backlash. Brexit, the rise of populist parties, anti-immigrant rhetoric, all are reactions to rapid demographic changes. The U.S. is in a more favorable position due to a historically more liberal immigration policy. But here too, immigration has become a toxic topic. If developed countries close their borders due to political pressure, demographic shrinkage will accelerate. Another subtle effect is the change in consumption structure. Older people consume differently than the young. They spend less on education, housing if they already own, durable goods. They spend more on healthcare, travel, services. This changes the structure of the economy. Sectors focused on young consumers shrink. Sectors for the elderly grow. An aging society is also less innovative. Most breakthrough innovations are created by people aged 25 to 45. When a society's median age is 50, dynamism declines. Research shows that countries with younger populations grow faster and are more receptive to new technologies. Japan is a clear example. A technological leader in the 1980s, it has stagnated for the last 30 years, largely due to aging. There are positive aspects as well. Older people possess experience, knowledge, capital. A society with a high proportion of educated, experienced people can be more stable and less prone to extremism. But the economic dynamics are clear. Aging slows growth, creates fiscal pressure, and redistributes resources from investing in the future to maintaining the present. Demographics is the only macroeconomic trend with near absolute predictability. The people who will retire in 2040 are already born. Their numbers are known. The rate of aging is known. The only variable is migration, but even mass immigration cannot compensate for the structural shrinkage of the working-age population on the scale needed to stabilize the system. Some countries try to stimulate fertility. Hungary offers women who have 4 children a lifetime exemption from income tax. South Korea spends billions on family support programs. The results are minimal. Fertility is determined by deep socio-economic factors: the cost of raising children, women's career ambitions, urbanization, housing affordability. Monetary incentives help at the margin but do not reverse the trend. Demographics is a slow but absolutely inevitable mechanism. It cannot be canceled by monetary policy, It cannot be compensated for by fiscal stimulus. It simply happens. And when investors begin to discount this trend into the valuation of long-term assets, the structure of global capital markets will be transformed. Pension funds are not just market participants. They are the largest institutional investors in the world, managing assets of over $50 trillion. They hold about 30% of all stocks in developed countries, 40% of corporate bonds, and a significant share of real estate and alternative assets. When these funds change strategy, markets change with them. The fundamental problem for pension funds is the mismatch between liabilities and assets over time. Liabilities are fixed, to pay pensions for 20-30 years after retirement. Assets must generate sufficient returns to cover these liabilities. Historically, funds assumed an average annual return of 7 to 8%. This figure was realistic in an era when long-term rates were higher and stock markets showed stable growth. Today, the situation is different. After decades of falling interest rates, the yield on risk-free assets approaches zero or even goes negative. 10-year U.S. government bonds yield 4-5%, German 2-3%, Japanese less than 1%. Investment-grade corporate bonds offer 4-6%. With such rates, achieving 7% annually without taking significant risk is impossible. This creates the first fundamental distortion. Pension funds are forced to shift into riskier assets. The share of equities in the portfolios of large funds has grown from 50% in the 1990s to 60 to 70% today. Exposure to private equity, hedge funds, infrastructure projects, and real estate has increased several-fold. Funds become hostages to market volatility precisely when they need stability most. The second distortion is liquidity mismatch. Pension funds must make regular, predictable pension payments. But an increasing share of their assets is in illiquid instruments, private equity, venture capital, infrastructure, direct real estate investments. In stable times, this is not a problem. But in a crisis, when it's necessary to quickly convert assets into cash, these funds face forced sales at unfavorable prices. The British pension crisis of 2022 was a clear illustration of this dynamic. A sharp rise in government bond yields after Liz Truss's mini-budget created margin calls for pension funds using derivative instruments for hedging. Funds were forced to urgently sell assets, amplifying the market decline. Only emergency intervention by the Bank of England prevented a systemic collapse. The mechanism was as follows. Many British pension funds used liability-driven investment, LDI, strategies. The idea is simple: hedge interest rate risk using derivatives and leverage. When government bond yields spiked by 100+ basis points in a few days, the value of these derivatives fell, creating demands for additional collateral. Funds had to immediately post cash or sell assets. The problem: a large part of the assets were in illiquid instruments. Funds began massively selling gilts, UK government bonds, which further crashed their price and raised yields. A death spiral ensued. The Bank of England was forced to launch an emergency $65 billion bond buying program, effectively becoming the buyer of last resort. This was not an isolated incident. It was a warning of what happens when huge, highly leveraged institutions with rigid liabilities encounter market volatility. And this is just a precursor. When demographic pressure forces funds to sell assets en masse to meet growing liabilities, similar crises will become regular. Another case is CalPERS, the California Public Employees Retirement System, the largest public pension fund in the U.S., with assets of about $450 billion. CalPERS has a funding ratio of about 70%, meaning assets cover only 70% of the actuarial present value of liabilities. The deficit is about $140 billion. CalPERS assumes a return of 6.8% annually to achieve its funding goals. But in an environment of low interest rates and overvalued equity markets, that figure looks optimistic. If the actual return is 5%, the deficit grows exponentially. This means either increasing contributions from employers, municipalities, and the state, cutting payments to retirees, or both. Many municipalities in California already spend 30–40% of their budget on pension contributions. That's money not going to schools, police, infrastructure. Some small cities have declared bankruptcy precisely due to unaffordable pension liabilities. Stockton, San Bernardino, Vallejo all went through municipal bankruptcy, largely due to pension expenses. The third distortion is overexposure to overvalued assets. In the search for yield, Pension funds become buyers at the peak. Real estate in major cities, infrastructure projects with questionable economics, late-stage venture capital, all assets where pension fund hot money flows. When these assets correct, funds incur losses precisely when their liabilities are growing. Commercial real estate has become particularly problematic after the pandemic. Many pension funds have significant exposure to office real estate in major cities. But remote work has fundamentally changed demand for office space. Vacancy rates in some cities exceed 20–30%. The value of office buildings has fallen 30–50% in some locations. Pension funds that invested in office REITs or hold direct real estate investments are incurring losses. The problem is compounded by the fact that real estate valuation often lags behind market reality. Funds may continue to carry real estate at historical cost, slowly adjusting valuations downward. This creates an illusion of stability until the moment of actual sale. Infrastructure has become a particularly popular asset class among pension funds. The logic seems compelling: long-term, predictable cash flows, inflation protection, low correlation with other assets. But reality is more complex. Many infrastructure projects are overvalued. Competition for assets has driven multiples to levels where expected returns barely cover the cost of capital. And risks, regulatory, political, technological, are underestimated. Wind and solar farms, toll roads, airports, water networks all look like stable assets. But their profitability depends on regulatory decisions, subsidies, political stability. A change in energy policy can destroy the value of renewable energy investments. A change in transportation patterns can make toll roads unprofitable. Example: many pension funds invested in toll roads in the 2010s. It was assumed traffic would grow 2–3% per year, providing stable cash flow. But in reality, traffic often grew slower or even declined due to changing demographics, urbanization, remote work. Actual returns turned out significantly lower than projected. Renewable energy investments seemed like a sure bet in the era of climate commitments. Governments guaranteed feed-in tariffs, fixed prices for electricity from renewable sources. But in many countries, these tariffs were cut retroactively, destroying project economics. Spain, for example, cut solar subsidies in 2013, creating losses for investors. Pension funds that assumed 20–30 years of guaranteed payments faced regulatory risk they had underestimated. The fourth distortion is financial repression. When states face huge pension liabilities with low growth rates, they resort to hidden expropriation via inflation and regulatory pressure. Pension funds become captive buyers of government bonds. Regulators raise requirements for the share of safe assets, forcing funds to buy government bonds with negative real yields. This is a transfer of wealth from future retirees to the state. The real value of pension assets is eroded by inflation, while nominal liabilities remain fixed. Pensioners pay for the state's fiscal failure through reduced purchasing power of their pensions. European countries actively use this mechanism. When the ECB pursued negative interest rate policy, states borrowed at rates below inflation. Real interest rates were deeply negative. This means bondholders, including pension funds, incurred real losses, subsidizing governments. In Japan, over 40% of government debt is held by the Bank of Japan, which bought it as part of quantitative easing. But a significant portion of the remaining debt is held by pension and insurance funds. With JGB yields around 0.5% and even moderate inflation of 1–2%, real returns are deeply negative. Japanese pension funds are slowly losing the purchasing power of their assets. The fifth distortion is herding behavior and crowded trades. When all major pension funds simultaneously move into one asset class, it creates overvaluation and systemic vulnerability. In the early 2020s, everyone rushed into private equity. Fundraising reached record levels. Dry powder, uninvested capital, exceeded $2 trillion. This means too much money is chasing too few good deals. Result: buyout multiples soared to 12–15x EBITDA. At such prices, future returns inevitably fall. The IRR of private equity funds launched in 2020–2022 will likely disappoint. But pension funds continue to increase allocations to private equity because they see everyone else doing it and fear falling behind. The systemic risk created by pension funds is underestimated. These institutions are too big to be allowed to fail, but their structure makes them vulnerable to shocks. In the next serious crisis, Pension funds may become not stabilizers, but sources of volatility. Forced selling, forced sale of assets to meet liabilities creates procyclical dynamics. When the market falls, funds are forced to sell, amplifying the decline. When the market rises, they buy at the peak. This is the opposite of a long-term investor's strategy, which should buy low and sell high. In the 2008 crisis, some pension funds were forced to sell stocks at the market bottom, locking in losses to meet short-term obligations. Those with sufficient liquidity, who could wait for the recovery, earned huge returns. Those forced to sell lost forever. Asset correlation spikes during a crisis. The diversification funds rely on disappears precisely when it's needed most. Stocks, corporate bonds, real estate, alternative assets all fall simultaneously when the market reprices risk. In a crisis, investors flee to cash and government bonds, selling everything else. 2022 was unusual in that both stocks and bonds fell simultaneously. The classic 60-40 portfolio, 60% stocks, 40% bonds, lost about 17%, the worst result in 40 years. Usually bonds serve as a hedge against falling stocks. But when inflation soars and central banks raise rates, both stocks and bonds suffer simultaneously. Pension funds relying on negative correlation were caught off guard. Pension funds also create moral hazard. They know governments won't let them go bankrupt because the consequences for retirees would be catastrophic. This creates an incentive to take excessive risk. If the bet works, the fund meets its obligations. If it doesn't, the state comes to the rescue. Taxpayers bear the downside risk, while fund managers get bonuses for taking risk. Infrastructure has become a particularly popular asset class among pension funds. The logic seems compelling: long-term, predictable cash flows, inflation protection, low correlation with other assets. But reality is more complex. Many infrastructure projects are overvalued. Competition for assets has driven multiples to levels where expected returns barely cover the cost of capital, and risks, regulatory, political, technological, are underestimated. Wind and solar farms, toll roads, airports, water networks all look like stable assets. But their profitability depends on regulatory decisions, subsidies, political stability. A change in energy policy can destroy the value of renewable energy investments. A change in transportation patterns can make toll roads unprofitable. The fourth distortion is financial repression. When states face huge pension liabilities with low growth rates, they resort to hidden expropriation via inflation and regulatory pressure. Pension funds become captive buyers of government bonds. Regulators raise requirements for the share of safe assets, forcing funds to buy government bonds with negative real yields. This is a transfer of wealth from future retirees to the state. The real value of pension assets is eroded by inflation, while nominal liabilities remain fixed. Pensioners pay for the state's fiscal failure through reduced purchasing power of their pensions. The systemic risk created by pension funds is underestimated. These institutions are too big to be allowed to fail, but their structure makes them vulnerable to shocks. In the next serious crisis, pension funds may become not stabilizers, but sources of volatility. Forced selling, forced sale of assets to meet liabilities, creates procyclical dynamics. When the market falls, funds are forced to sell, amplifying the decline. When the market rises, they buy at the peak. This is the opposite of a long-term investor's strategy. Asset correlation spikes during a crisis. The diversification funds rely on disappears precisely when it's needed most. Stocks, corporate bonds, real estate, alternative assets all fall simultaneously when the market reprices risk. Pension funds become hostages to their own liabilities. They cannot afford long-term drawdowns but are forced to take risks that make these drawdowns inevitable. This is a structural trap with no exit within the current paradigm. When math breaks politics, the system changes. The pension crisis will not be solved by gradual adjustments. It will require radical transformation of the social contract and the creation of new financial instruments. The baseline scenario for all developed countries is raising the retirement age. It's not a question of if, but when and by how much. If life expectancy has increased by 15 years since most pension systems were created, it's logical that the retirement age should rise by a similar amount. A retirement age of 70-72 will become the norm by 2040 in most OECD countries. Some countries will go further, automatically linking the retirement age to life expectancy. But raising the retirement age is not a solution, it's a delay. It buys time but does not eliminate the fundamental imbalance. With current life expectancy trends, even a retirement age of 72 means the average person will spend 15–18 years in retirement, consuming significantly more medical services in the final years. The second inevitable change is a reduction in real payouts. This will happen covertly through several mechanisms. Pension indexation will be tied to inflation, not wage growth, meaning pensions gradually fall behind the standard of living of the working population. The replacement ratio, the ratio of pension to last salary, will decline. If today it is 50–60% in developed countries, by 2050 it will drop to 30–40% for many categories. Taxation of pensions will increase. What now looks like a guaranteed payment will become subject to progressive taxation, healthcare fees, and other deductions. The net value of the pension to the recipient will be significantly lower than the nominal amount. The third change is the transition from defined benefit to defined contribution. Systems with fixed payouts, defined benefit, where the state or corporation promises a certain pension regardless of market conditions, will be replaced by systems with fixed contributions, defined contribution, where investment risk is shifted to the individual. This is a fundamental risk shift. In a defined benefit system, the employer or state bears the investment risk. If assets haven't grown enough, it's the employer's problem. In a defined contribution system, the individual bears the risk. If the market falls before retirement, the pension is smaller. If the person lives longer than expected, the money runs out. This transition has already occurred in the US and UK corporate sectors. Virtually all new pension plans are defined contribution. State systems are following with a lag, but the direction is clear. Sweden, the Netherlands, Denmark have already implemented hybrid systems where part of the pension depends on investment returns. Against this backdrop, new financial constructions are emerging, designed specifically for an aging world. Longevity bonds, bonds linked to life expectancy, are instruments for hedging longevity risk. Pension funds and insurance companies face a huge risk. What if people live significantly longer than projected? Longevity bonds solve this problem. Their payouts increase if people live longer, compensating for funds' additional expenses. So far, the market for these instruments is small, but it's growing. The first longevity bonds were issued in the early 2000s. Today, large insurance companies and pension funds are increasingly using longevity swaps, derivative contracts where they exchange fixed payments for payments linked to mortality statistics. The privatization of pension risks is a broader trend. The state is gradually exiting its role as guarantor of pension provision and becoming a regulator setting minimum standards. Responsibility for pension savings is shifting to the individual. This creates a huge market for financial products, target date funds, annuities, longevity insurance. Target date funds automatically reduce portfolio risk as the target retirement date approaches. At age 30, the portfolio is 90% in stocks. At age 60, 30% stocks, 70% bonds. The idea is simple, but execution is complex. Many of these funds performed poorly in crises because algorithms underestimated asset correlation in stress scenarios. In 2008, many target date funds designed for people retiring around 2010 lost 25–30%. This is devastating for someone 2 years from retirement. The problem is that even conservative portfolios contained a substantial share of stocks, and when correlation between stocks and bonds increased, diversification didn't work. People planning to retire were forced to work several more years waiting for market recovery. Annuities, insurance products guaranteeing fixed payments for life, are becoming critically important, but they are expensive. To buy an annuity providing $30,000 per year, a 65-year-old needs to pay about $500,000. This is unattainable for most. Only the top 20% by income can afford a full replacement of the state pension through private annuities. Annuities have another problem. They are not protected from inflation unless explicitly purchased as inflation-indexed annuities, which are significantly more expensive. A fixed annuity paying $30,000 per year will have a purchasing power of about $20,000 in 20 years with 2% annual inflation. With 4% inflation, about $13,000. This means the annuity buyer bears huge inflation risk. Variable annuities offer exposure to the stock market with a guaranteed minimum payout, but their fee structure is complex and expensive. A typical variable annuity charges 2 to 3% per year in fees and expenses. Over 20 years, this eats up about 40% of the value. That's the price for the guarantee, but many buyers don't realize its scale. Life as a financial contract is the extreme expression of pension risk privatization. Ideas are emerging about securitizing future pension flows, selling inheritance rights in exchange for a lifetime annuity, reverse mortgages where the elderly monetize their home equity. A reverse mortgage, or equity release in the UK, allows an elderly homeowner to obtain a loan secured by their home without selling it and while continuing to live there. The debt is repaid after death from the home's value. This can provide additional cash flow in retirement. But interest rates are high, typically 5 to 7%, and the debt grows exponentially. A person taking a $200,000 reverse mortgage at age 65 at 6% will owe about $640,000 by age 85. If the home hasn't appreciated accordingly, nothing will be left for heirs. Longevity derivatives, derivative instruments linked to mortality statistics, are a growing market. JP Morgan, Goldman Sachs, Deutsche Bank are actively developing these products. The idea: pension funds and insurance companies have huge exposure to longevity risk. If people live longer than projected, expenses explode. Longevity swaps allow hedging this risk by exchanging fixed payments for payments dependent on actual mortality. The first major longevity swap was concluded in 2008 between a British pension fund and Deutsche Bank for $1.5 billion. Since then, the market has grown to tens of billions. But this is still negligible compared to the scale of longevity risk in global pension systems. Investment opportunities in an aging world are significant, but they require rethinking classical strategies. Assets that benefit from aging are not only obvious sectors like healthcare, it's an entire ecosystem: pharmaceuticals, medical equipment, care facilities, home healthcare, age tech, financial services for the elderly, funeral services. Healthcare spending grows exponentially with age. A person over 75 consumes 4 to 5 times more medical services than a 50-year-old. In the U.S., Medicare spending, government health insurance for the elderly, already exceeds $700 billion per year. By 2040, it will double. Pharmaceutical companies specializing in chronic diseases, diabetes, cardiovascular disease, Alzheimer's, have a growing market. Manufacturers of medical equipment for home care, telemedicine, wearable health monitors, all are segments with long-term growth. Alzheimer's disease is becoming one of the largest medical and financial problems. Today, about 6 million Americans live with Alzheimer's. By 2050, about 14 million. The average cost of care is $350,000 over the course of the illness. That's $5 trillion in total expenses for the current cohort. Companies developing effective treatments or early detection methods will have a huge market. The care economy, the sector of elderly care services, will become one of the largest markets. Assisted living facilities, nursing homes, in-home care services, demand is growing faster than supply. But this is a complex market with high regulatory risks and profitability issues. A typical assisted living facility costs $4,000, $6,000 per month. A nursing home with full care, $8,000, $10,000. For most retirees, this is unaffordable without selling their home or exhausting all savings. Medicaid, the state program for low-income individuals, covers about 60% of nursing home costs in the U.S., but only after the person has spent nearly all their assets. Age tech, technology for the elderly, is in its early stages but has huge potential. Helper robots, health monitoring systems, interfaces adapted for people with cognitive impairments, social platforms for the elderly. This market is small now but will grow many times over. Japanese companies lead in age tech. Toyota is developing helper robots for the elderly. Panasonic creates smart homes adapted for people with limited mobility. SoftBank invests in companion robots. This is not science fiction, it's a necessity in a country lacking workers to care for a growing number of elderly. Markets focused on cash flow, not growth, will become more attractive. In an aging economy, there is less innovation and breakthrough growth, but more stable cash flows. Utilities, telecommunications, infrastructure, REITs with long-term tenants, assets generating predictable income. Utilities, electricity, gas, water, are natural monopolies with regulated tariffs. Demand is stable regardless of the economic cycle. people always need electricity and water. Utilities were traditionally considered boring investments, but in an aging world, stability is valued more than growth. Many utility companies have dividend yields of 3–5% and steadily raise dividends by 3–4% per year. This is a reliable income source for retirees. Telecommunications companies also generate stable cash flows. Everyone pays for mobile service and internet. This is recurring revenue with high predictability. AT&T, Verizon, Deutsche Telekom trade with dividend yields of 5–7%, substantially higher than bond yields. The risk is that telecom is a capital-intensive business requiring constant investment in networks and technology. But for mature markets, cash flows remain stable. Real estate investment trusts, REITs, offer exposure to real estate with public stock liquidity. But not all REITs are equal. Office REITs suffer from structural changes. Retail REITs face e-commerce competition. The most resilient are residential REITs, housing, healthcare REITs, medical real estate, data center REITs. Healthcare REITs are especially interesting in the context of aging. They own assisted living facilities, nursing homes, medical offices. Demand for this real estate grows structurally. Welltower, Ventas, HealthPeak, the largest healthcare REITs, have long-term contracts with operators ensuring stable rental income. Data center REITs benefit from digitalization and growth in cloud computing. Equinix, Digital Realty own critical internet infrastructure. These are mission-critical assets with long-term contracts and high barriers to entry. Dividend yields are 2–3%, but growth is stable. Dividend aristocrats, companies that have steadily raised dividends for decades, will be revalued. In a world where state pensions are insufficient, individual investors seek replacement in the form of dividend income. This creates a sustained bid for companies with strong balance sheets and stable cash flows. The S&P 500 Dividend Aristocrats Index includes companies that have raised dividends for at least 25 consecutive years. Procter & Gamble, Coca-Cola, Johnson & Johnson, 3M. These are boring, predictable businesses that generate cash in any economic environment. Their dividend yields are typically 2–3%, but regular increases create a compounding effect. For an investor who retired in 2000 with a portfolio of dividend aristocrats, the initial yield might have been 2.5%. But by 2025, after 25 years of dividend growth, the yield on cost, dividends relative to the original investment, could reach 6–7%. This is a powerful mechanism for inflation protection and providing growing income. Contrast this with a bond ladder, a traditional retirement investor strategy. You buy bonds with different maturities, ensuring regular cash flow. But bonds don't grow with inflation. The coupon is fixed. In 20 years, the purchasing power of the same coupon is significantly lower. Dividend growth stocks offer inflation protection that bonds don't. But they are more volatile. In a crisis, stocks fall even if dividends continue to be paid. Psychologically, this is tough for a retiree watching their portfolio value drop 30–40%. The optimal strategy for a retiree is a combination. Enough bonds and cash to cover 3–5 years of expenses, protecting against the need to sell stocks in a crisis. The rest in dividend growth stocks, providing growing income and long-term inflation protection. But the main investment shift is the rethinking of the long horizon. Traditionally, long-term investing was considered an advantage. More time for compounding, the ability to ride out volatility. In an aging world, a long horizon becomes a risk. If in 20 years economic growth slows due to demographics, the equity risk premium compresses, and asset returns fall, then long-term investments in growth stocks may disappoint. The equity risk premium, the extra return of stocks over risk-free bonds, historically was 4–6% per year. This is compensation for risk and volatility. But this premium depends on expectations of economic growth. If growth expectations fall, the premium compresses. In an aging, slow-growing economy, the equity risk premium might be 2–3%, not 5–6%. This means expected stock returns decline. If the risk-free rate is 3% and the equity risk premium is 3%, expected stock return is 6%. In the past, with a 5% premium, it would have been 8%. A 2 percentage point difference seems small, but over 20–30 years, it's huge. At 8% annual return, capital doubles in 9 years. At 6%, in 12 years. Smart investors will begin discounting the demographic headwind into the valuation of long-term positions now. This means a more cautious approach to stocks with high multiples, greater focus on current cash flows, less faith in perpetual growth. Tech stocks trading at 40-50x earnings with promises of 20% annual growth will face harsh revaluation. If economic growth slows to 1 to 2%, how many companies can grow at 20%? Only those capturing market share. But aggregate growth is limited by overall economic growth. Value investing, buying undervalued companies with low multiples, may come back into fashion. After a decade of growth stock dominance, revaluation seems inevitable. Companies with PE of 10-15, stable cash flows, strong balance sheets, may outperform high-flying tech stocks in a world of slowing growth. Another aspect is geographic diversification. Not all countries age equally. India, Sub-Saharan Africa have young populations and potential for rapid growth. Investments in these regions are a hedge against developed market aging. But they carry their own risks: political instability, weak institutions, currency risk, corruption. Frontier markets, Vietnam, Bangladesh, Kenya, offer exposure to young, growing economies. But liquidity is low, volatility high, information limited. This is not for a conservative retirement portfolio, but as a small allocation, it can provide diversification. There are also sector-specific opportunities directly linked to the consequences of the pension crisis. Financial companies specializing in wealth management for elderly clients, insurance companies offering longevity products, asset managers focused on income strategies, all are growing niches. Charles Schwab, Fidelity, Vanguard build business models around retirement accounts. Their assets under management grow not only from market appreciation, but from demographics. Millions of baby boomers consolidating retirement assets. These companies have a structural tailwind. The insurance sector is also transforming. Traditional life insurance is losing relevance. Who needs life insurance at 70? But annuities and long-term care insurance are growing. MetLife, Prudential, Manulife are developing products for the retiring population. This is a complex business with actuarial risks, but demand is structural. The asset management industry is shifting from pure alpha generation to liability-driven investing and outcome-oriented strategies. BlackRock, State Street, PIMCO create products designed specifically for the decumulation phase, the spending phase after accumulation. Target date funds with automatic glide paths, managed payout funds, dynamic asset allocation, all are growing segments. Real assets, physical assets protected from inflation, are also attractive. Farmland, timberland, infrastructure, precious metals. These assets have historically performed well during periods of financial repression and high inflation. When states print money to finance pension liabilities, real assets preserve value. Farmland is especially interesting. Arable land is limited, population is growing, climate is changing. Demand for food grows structurally. Returns on farmland have historically been about 10-12% per year, a combination of land appreciation and rental income from farmers. Bill Gates has become the largest private owner of U.S. farmland, accumulating about 270,000 acres. This is no coincidence. Timberland, forest lands, has similar dynamics. Trees grow regardless of economic cycles. Demand for timber is stable. Institutional investors like pension funds and endowments hold 5 to 10% of their portfolio in timberland as an inflation hedge and diversification. Precious metals, especially gold, are traditionally viewed as a hedge against monetary debasement. When central banks print trillions to finance pension and other liabilities, gold preserves purchasing power. Historically, gold doesn't have high returns, but serves as insurance against extreme scenarios. Bitcoin and other cryptocurrencies are offered as digital gold, but their volatility makes them unsuitable for a conservative retirement portfolio. A young investor with a 30-40-year horizon might afford a small allocation to crypto as a venture bet. A retiree with a 15-20-year horizon finds it too risky. There is also geographic arbitrage, the possibility to move to a country with a lower cost of living. An American or European retiree with $2,000 per month lives poorly in their home country, but comfortably in Portugal, Thailand, Mexico. Thousands of retirees do this, seeking a better quality of life for less money. Portugal, for example, offers a special tax regime for foreign retirees, 10% flat tax on pension income for 10 years. With a mild climate, developed infrastructure, and an English-speaking population, it's an attractive destination. Many French, German, British retirees have moved to Portugal over the last 10 years. Thailand, Vietnam, Malaysia are popular among Asian and Western expat retirees. The cost of living is half to a third of Western countries. Healthcare is quality and affordable. The climate is warm, but this means separation from family, friends, cultural roots. Not everyone is ready for that. Mexico attracts American retirees due to proximity, easy to visit family in the U.S. Cities like San Miguel de Allende, Playa del Carmen, have become retirement hubs with large expat communities. The cost of living is lower, weather better, lifestyle relaxed. But geographic arbitrage carries risks, currency risk, political instability, healthcare quality, safety. If the local currency devalues, the cost of living advantage disappears. If the political situation destabilizes, evacuation may be needed. If health deteriorates, access to quality medicine is critical. Healthcare costs are one of the largest uncertainties in retirement planning. An average couple retiring at 65 in the U.S. will spend about $315,000 on healthcare during retirement. And that's with Medicare. A serious illness can easily double that figure. Long-term care, nursing home or in-home care, costs $100,000+ per year. Long-term care insurance is designed to cover these expenses but is expensive. A typical policy costs $3,000 to $5,000 per year for a 60-year-old. Many people skip coverage, hoping they won't need it. But statistics, 70% of people over 65 will require some form of long-term care in their lifetime. Health savings accounts, HSAs, in the U.S. offer a triple tax advantage for healthcare savings. Contributions are tax-deductible, growth is tax-free, withdrawals for qualified medical expenses are tax-free. This is a powerful tool but underutilized. Maximizing HSA contributions and investing the funds for growth is a smart strategy. Estate planning is also critical. How to transfer wealth to the next generation efficiently? Trusts, wills, beneficiary designations, gifting strategies all require planning. Without a proper estate plan, a significant portion of wealth can be lost to taxes and legal fees. Generation-skipping trusts allow transferring wealth to grandchildren, bypassing estate taxes at the children's level. Charitable remainder trusts provide income during life, then transfer the remainder to charity with tax deductions. Life insurance trusts protect proceeds from estate taxes. But estate planning isn't just about taxes. It's also preventing family conflicts, protecting assets from creditors and lawsuits, ensuring wishes are carried out. Many people put this off, but sudden death or incapacitation can leave a family in a chaotic situation. Powers of attorney, financial and medical, are critical. If a person becomes incapacitated due to stroke or dementia, who makes decisions? Without proper documents, the family may end up in a lengthy court process to obtain guardianship. The pension crisis is not an event. It's a process stretched over decades. There won't be a moment when the system collapses. There will be slow erosion of promises, gradual lowering of expectations, revaluation of what is considered normal. The state is no longer an anchor. The illusion that the government guarantees a dignified old age is fading, not because the state is malicious, but because the math doesn't work. When every second voter is a retiree, the political system is paralyzed. Reforms are postponed until the last moment when there is no choice left. Responsibility shifts to the individual and to capital. Those who have saved enough, who have diversified risks, who invested in the right assets, will live comfortably in old age. Others will face a sharp drop in living standards after retirement. A pension will become a marker of class division stronger than ever. A long horizon as risk, not advantage. In the 20th century, long-term thinking was rewarded. The economy grew, markets rose, compounding worked. In the 21st century, a long horizon means exposure to demographic decline, slowing growth, asset revaluation. An investor thinking 30 years ahead must consider that the world in 30 years will be fundamentally different. From guarantees to probabilities, a pension is no longer a promise but a forecast with a confidence interval. Retirement planning turns into actuarial modeling. How long will I live? What asset returns are realistic? How will inflation erode purchasing power? What if markets fall just before retirement? From promises to models. The financial industry will offer increasingly complex instruments, dynamic annuities, longevity insurance, managed payout funds. But complexity is not a solution. It's a way to hide the fundamental problem. The aggregate of promises exceeds the aggregate of resources, from pension as a right to pension as a strategy. In a world where the state cannot guarantee a pension, the individual must build their own strategy. This requires financial literacy most lack. It requires capital most don't have enough of. It requires discipline hard to maintain for decades. Aging is not the crisis. The crisis is the illusion that someone will pay for the future. Demographics is an objective reality. The problem is not that people live longer. The problem is a system of promises built on the assumption that they wouldn't. An investor understanding this dynamic has an advantage, not because they can avoid the consequences of the pension crisis, but because they can position themselves before the market fully reprices the risk. This means skepticism towards long-term state obligations. Focus on assets generating real cash flows. Diversification through jurisdictions with more sustainable demographics. Exposure to sectors benefiting from aging. Hedging longevity risk through financial instruments or real assets. The 2040 pension crisis has already begun. It is happening slowly beneath the surface in the actuarial reports and stress tests of central banks. When it manifests openly, most of the repricing will have already occurred. Smart investors don't wait for the crisis. They adapt to the new reality before it becomes consensus. The finale is not a conclusion or a solution. It's an invitation to reconsider fundamental assumptions about the future. Pensions as an institution were a product of unique 20th century demographic conditions. Those conditions no longer exist. A system built on their basis cannot function in the new reality without radical transformation. But there is a deeper question. The pension as a concept was invented for an industrial economy where people worked for one employer for 40 years, retired at 65, and died at 70. That model no longer corresponds to reality. People change careers 5 to 7 times in a lifetime. They work as freelancers, contractors, gig workers. They live to 85, 90. Perhaps the very concept of retirement at 65 with a complete cessation of work is outdated. Maybe the future lies in a gradual transition, slowly reducing working hours from 60 to 75, combining work and leisure, flexible retirement instead of a clear line. Sweden, the Netherlands already offer flexible options, partial pension, while continuing to work part-time. Psychologically, many people are not ready for full retirement. Work provides not only income but identity, structure, social interaction. A sharp transition to complete idleness can be depressing. For knowledge workers, working until 70 is quite realistic. There is also the idea of a universal basic income as a replacement for pensions. Instead of a complex system dependent on tenure and contributions, everyone above a certain age receives a fixed sum. But UBI requires enormous resources. Where to get the money? Higher taxes on the shrinking working population? An alternative is sovereign wealth funds financed from natural resources. Norway has a $1.5 trillion fund from oil revenues. But not all countries have oil. Other sources, privatization of assets, land taxes, inheritance taxes, financial transaction taxes, each is politically difficult. Some economists propose pension buyouts. The state gives a lump sum payment in exchange for giving up future pensions. For the state, this reduces future liabilities. For the individual, it's longevity risk. What if the money runs out? The optimal solution is a combination of measures: retirement age linked to life expectancy, transition to defined contribution with automatic enrollment, financial education as a mandatory part of the curriculum, longevity insurance to hedge longevity risk, flexible options allowing combination of work and pension, minimum guaranteed pension from general taxes, incentives to continue working past the standard age. For the individual investor, this means plan independently, not relying on the state. Start saving early. Compounding is huge over a long horizon. Diversify across assets, jurisdictions, currencies. Focus on assets generating real cash flows. Avoid excessive leverage, especially close to retirement. Regularly review the plan, adapting to changes. Health as an investment. The longer you can work, the more secure your position. Philosophically, the crisis forces a rethinking of the social contract between generations. In the 20th century, workers paid for retirees with the expectation that the next generation would pay for them, an implicit deal based on trust and demographic growth. Now that contract is breaking down. The next generation is smaller and cannot bear the burden. The young are skeptical of pension promises 40 years from now. rightly doubting they will be fulfilled. A new contract is needed, based not on intergenerational transfers, but on individual responsibility with collective insurance of a minimum level. Everyone is responsible for their own old age, but society guarantees no one dies in poverty. This is a shift from a paternalistic welfare state to a liberal model of personal responsibility with a social safety net. Politically controversial, especially in Europe. But economic reality may leave no choice. The pension crisis is not just a financial problem. It is an existential challenge for developed societies. How to care for the elderly when there are too many of them? How to balance obligations to the past and investments in the future? How to allocate limited resources between generations? The answers are determined not by philosophy but by mathematics, and the math is inexorable. A system based on demographic growth cannot function under conditions of decline without fundamental transformation. Investors who realize this sooner than others have an advantage, not because they can avoid the consequences, but because they can adapt while others remain under illusions. The question is not whether there will be a crisis. The question is how capital adapts to the world after the illusion of a permanent pension. The future belongs to those who look at it without illusions.